Okay, we're live. Scott and Ben. I'm live
Happy
from my
Friday.
basement. Ben's live from Parliament Hill today, clearly.
Yes.
He's He's holding down the House of Commons over there at 50 O'Connor. There is like the 15th floor is the House of Commons.
It
where
is.
They have an office space. Yeah, there. Yeah.
Right below us. Yep.
Yeah. Yeah. I didn't realize that when I got off on the wrong floor the other day. So it's good.
Nice.
All right, Ben, let's just dive right in, eh? Let's just forego the witty banter on this November 5th and tell us all the exciting things that happened in the market this week.
Well, it's first week of November, of course, and market was off to a good start this week. A lot of people were watching. We had the Bank of England this week on interest rates. We had the Federal Reserve, of course, on rates, which a lot of people are still paying very close attention to and micro analyze every single comment that comes out of there. And so I met with some clients this week and we were talking about why does everyone care so much about the central bank in the US? And the answer is they're 50+% of world GDP still. So, and they are the world reserve currency. So as a result of those two combinations, they tend to get a lot of the attention and a lot of focus gets put towards what it is that they're doing. So that was really the big, I'd say, economic news of the week was the central bank meeting on Wednesday.
Yeah.
Yep.
What was the result of said meeting?
So they said they were going to reduce their bond purchasing. Right now, they're buying bonds and mortgages $120 billion a month. So they said they were going to reduce that by 15 billion effective November, so this month. And Powell's had some trouble in the past before talking about being on cruise control.
Mm-hmm.
A few years back when he was talking about rates. So he didn't say that, but effectively he said that they will continue to reduce their quantitative easing. We saw they have this dot plot, which lays out where they think interest rates are going to start to rise. When the people I listened to, a bunch of different viewpoints, I think you got about a 95% present likelihood in January of 2023 that they will raise rates. When I see that, I think, who cares? That's a year and change out. A lot's going to happen between now and then. Others tended to lean that maybe they'll raise rates in September. I mean, I think they have nowhere to go. I think they can't raise rates at all. But those numbers were interesting. I'd say the biggest divergences we had, some of the smaller central banks come out and talk about raising rates. So what we had, Bank of England, now the Fed came out and said, we're not doing anything. We saw some other central banks like Canada say, we're going to raise rates soon, and presently priced in about a 50% likelihood of a rate increase in January of next year, so 22. We had the Bank of Australia say they're going to raise rates. We had the Czech bank, central bank, actually raise rates last week. So it's been a pretty severe divergence between some of the smaller economies and the major players, which are on hold. So I don't know exactly how to interpret that, but I think it's going to likely play an impact on currencies, imports, maybe some opportunities. It's kind of early days in my thinking around that, but those two things have been really kind of interesting divergence.
Okay, great.
Yeah.
As always, if you have any questions, just hit the question, so the Q&A button down below, or put it in the chat, or raise your hand if you want to have your voice on the recording. Then you'll be famous, just like us, right, Ben?
That's right.
We can't forget to get to Eric's question. I think it was about gold, as it usually was, as it usually is. So we're going to tackle that today at some point, or not.
Yeah, for sure. I
Okay.
Haven't looked at it yet, so you can read it to me when you're ready.
Yeah, I thought we'd do
now?
that after. I just wanted to kind of refresh your memory if you wanted to pull it up. But yeah, I can read it to you after.
Okay.
Why don't you tell us what you did in the portfolios this week, and then we'll do questions after.
Yeah, so coming into the week, I think there was a lot of attention towards the central bank. So markets kind of meandered around a little bit higher until this announcement. There's a couple of one-off returns from companies I want to mention, but from a market perspective, we saw things kind of do not too much. Then after the meetings, we saw markets kind of start to take off. So NASDAQ, technology, some of the things that I'm mentioning over the last, probably 3 to 4 weeks, where I thought there was some upside ahead with NASDAQ and tech, they kind of took off. As a result of that, I reduced exposure to tech today, XLK and QQQ. Really looking at, we've had a reasonable run. A couple of the slides I'll show you will give you some context around how I'm starting to think, but reasonable run. Looks like commodities can continue to do well a little bit here. So I may look to reduce some exposure to energy. I'd bought AMLP last week, which is the pipelines, but looks like there's still some decent upside there. DBB, which was the base metals, looks like still some upside, as I've mentioned the last couple of weeks, where we've got that looks like a re-acceleration after this Delta variant has passed. That looks like it's going to continue. However, coming into the session today, part of the reason why I took some exposure down on tech, it was we got severe kind of overbought signals on technology. And so, when you get an overbought signal, which means maybe that runs extended and you get a price increase, that's about as good a point as any to take down your exposure. So that's what I did this week.
Okay, great.
Yeah.
Well, you know what it's time for, Ben? Everybody's favorite segment, Ben's charts.
The charts. All right.
Hit us with a good one right off the start.
Let's see. We'll see if we can do that. I'm looking forward to it.
The audience. Normally,
we're gonna do this, and just let me know when you can see it.
Yep, you're there. Equity and bond volatility.
I'm echoey.
I said it.
What? Am I a little bit echoey today? Oh, okay.
No. Okay, fear and greed index. Well, started with the good news, I guess. Let's get into it.
Well, I look at this thing every day. I don't put it out there every day. I do try to drop it into the emails occasionally. Tend to drop them in on extremes in either way, extreme fear or extreme greed. And part of my comments there around tech are really as well are related to something like this, right? And so it'd be great almost if you had one of these for every subset, and you kind of do from an overbought, oversold signaling. So, we're reaching that extreme level again. It does give me some concerns about where and how fast things have come, but really it's signaling, we're kind of at a greedy phase. Tends to be time to reduce exposure to what, I think, is the question. And where do you go with the money is the other question, but I'll just leave it at that, we're reaching these extreme levels. I do think we can probably extend. This is important to watch because, say we get a 2% correction next week, which is possible. If this ticks back down into the 50 range, that's probably a signal. Say you can put your exposure back up to probably tech or maybe commodities, depending what gets hit the hardest. But this is an important metric I always like to watch. Questions?
Interesting.
Yeah.
Okay, what else you got? Yeah, questions on that one? I mean, who put this one out? Who measures that?
Who measures this? This is a U.S. report, so it is essentially the overbought, oversold signal, and CNN, I think, is the one that accumulates all this information into coming up with a simple fear greed index. Dennis Gartman used to use this in his daily newsletter. If anyone knows Dennis Gartman, pretty famous newsletter writer. He had, 500,000 subscribers monthly, I think, mostly corporate. I read his stuff for 20 years. He retired, I think, December of 2018. But this was something in his report every day. Cool. Yeah. So on to the next one here. And so, I'm a double dipping on this one because I put this in the daily, but I think it's probably one of the most important things that I've seen in a long time. And so as we get to this kind of extended valuations, I've talked about this before, where people don't want to own bonds anymore. They think you're an idiot to have them in your portfolio. They want to just be risk on all of the time with no kind of guardrails to protect the portfolio. This is kind of a sentiment piece, but also a data piece to look at and say, we've had some pretty ugly periods in bonds over the history, at least over the last 80 years, 100 years. This past 12 months, this is US related data. So this past 12 months has been the worst period to own high quality US bonds since 1949. So it's most of anyone that I'm talking to here is investing career, where typically though, what happens when you have a horrible period, on the other side of this, you tend to get a really good period. So, we do have presently some exposure to government bonds, and the intention is, as we reduce equity weighting, as we look to position the portfolio for what I think is coming next year, this is an opportunity to say, where's the high quality bonds? How far out do I want to go? And if history repeats like it typically does, on the other side of a bad performance, you get pretty good performance, and the steepness and the severity, I guess we'll see. It depends what happens to the economy. But it's just a signal to say, yes, you want to have bonds in your portfolio. Yes, they've been a drag right now, but they're going to be a positive influencer in portfolios over the next 12 months. Good. Oh, you're just muted there. So I think I'll jump on to the next unless you had any questions.
I'm back.
You're back. Any questions on that one?
My internet dropped there. No questions on that one yet. No.
Okay.
Nope.
So, yep. So just on to the last one here, and then we'll jump out. This is a double slide, but I just kind of bookmarked. We talked earlier about the Bank of England, the major central banks that are part of kind of the central reserve basket. So Bank of England, Japan, US, they're talking about not raising rates. And then you kind of benchmark that against some of the smaller ones. This happened to be Czech central bank raised rates on the same day that the Bank of England did nothing. So it's interesting to see some of the central banks are choosing to attack inflation by raising rates and seeing if they can kind of slow down that. The pace of inflation. I guess we'll see how this plays out. Ultimately, I think they all head towards zero. They painted themselves into a corner right now where they have too much debt. It's slowing the economy, the debt. If rates rise, it's going to slow the economy further. So it's just interesting to see how it's coming about. And I'll have more conversation and context around this as it evolves, but it's kind of early days on a divergence, which we haven't seen from central bank policy in a couple of years.
Mm.
Then the last one is just about bonds and equities. So, there's the MOVE index, which is the bond volatility index, and there's the VIX, which everybody knows. The VIX is the volatility index in stocks. And so you get about as a high historic divergence. If we go back, if we stretch this chart back a lot longer too, we get a pretty historic divergence between, the MOVE index is moving up to extreme levels of weakness, where volatility is going the other direction, equity volatility. So you got a period where, as I mentioned on the previous slide, you got, bonds having a terrible time, you got equities doing quite well, and then you get a divergence in volatility of those two things. It tends to be something to say, listen, pay attention. The market's telling you something. The boat's heavily weighted to, long equities, everything's going to be fine. Nobody needs to worry about it. And you don't want to own bonds ever. When you get those two kind of divergences, it's a good time to say, this is one of the signals that we need to pay attention to.
Okay.
Makes sense?
Any questions about any of the charts? If not, we're gonna wrap up Ben's charts. Okay.
Right, we're shutting down the charts.
We're shutting down the charts. Oh, we got one.
Hmm.
We got one. All right, Lyle wants to know, why does wage inflation create an interest / attraction to gold?
Yeah, so I mean, wage inflation is a big input into the inflation metric. And so, so one thing that we haven't seen in the US, we haven't seen wage inflation in decades. In Canada, we've had a bit of wage inflation, but this is the first time in decades where we've actually seen some upside pressure in wages, and it's a major input to the inflation number. Obviously, I know we talked earlier this week about kind of that real inflation number, which is inflation minus interest rates, and the bigger the negative in that, the more attraction historically there's been in relation to gold. This kind of workforce participation that's getting a lot of attention in the media right now. Some of these things were already happening, right? We were having the aging population, demographics, people retiring. Some of this was going to happen anyways, even pre-pandemic, is where we saw a lot of retirees going into retirement, like at this period of time. And so now I think we got that combination where we had this hard stop where people stopped working, the coming back to work. A lot of those people that were, T minus 5 years from retirement have chosen not to come back. And so you got a kind of a reduced workforce size. And as a result of that, you've had the wage inflation because they need to pay more to get people back into the market. So it's been a while since we've seen this, but it's a big component to the inflation number. So that's why it seems like it's grabbed a lot of attention right now.
Interesting. Okay.
Yep.
Let's keep it rolling with Eric's question here.
Okay.
I was wrong. So sorry, Eric. It's not about gold.
Okay.
Following notably this week's key events are interest rates. Could you expand a bit on your views as to where you think we're headed over the next 3 to 4 quarters, including your take as to whether what are likely to be nasty US mid-elections next year might have a significant impact?
Yeah, so I guess short term, let's just take it, I'd say kind of one quarter at a time. So right now, I think as I've been saying, I still think we're this last quarter of the year. We probably see growth reaccelerate and inflation stay elevated. This Delta variant has passed, it seems, and as a result of that, it probably putting some upward pressure on prices. Some of the stock names that have really been hurt up until now seem like they're starting to pick up again. Like the airlines are coming back. Like Starbucks is having a good move here. Some of the other smaller cap names that we've owned and watched starting to come on, Las Vegas Sands, these kind of these consumer discretionary companies starting to come back. So that's the short-term view. I think that happens. Come into Q1, I think we'll see there's a couple of things going on in Q1. Some economic and some political. Looks like the U.S. has come up with a kind of a hard stop around January 4th that all companies have to have mandatory vaccination policies in place. And that's going to cause a bit of I'd say, kind of clash within the businesses. So that's one of the events that could kind of disrupt things, but assuming that doesn't have an impact, we probably see growth and inflation starting to slow sometime in Q1 or definitely in Q2. And so I would expect that we get growth and inflation slowing together into kind of late winter, early spring. That likely puts pressure on the central bank policies. I think the speed and the depth, it's still early to say what happens there. And in that kind of backdrop, typically you want to have exposure to government bonds, which I talked about before, and the US dollar, and potentially gold. And so I would say I'm still early to say whether that is what you want to own just yet. I think on the other side of that, I'd expect that we start to see the economy reaccelerate again, because central banks will be aggressive on coming right back, saying we're not going to raise rates, we're going to reduce our QE. And if I were to look 12 months out, I guess, is kind of what your question is. I'd expect that we see the economy start to kind of pick up. We get into the summer period this year wasn't solid, so the year-over-year comparables will probably be pretty reasonable next summer. So we should probably see stocks start to move higher. And the question is, are we going to get inflation and growth going together, or are we going to see growth and inflation slowing? I think that's a higher probability 12 months from now. So, we'll take it one quarter at a time right now, but generally it looks like the next 2 quarters, growth accelerating, followed by a pretty material deceleration on the back of that. So I'm most conscious on the next 6 months. Does that make sense? You're back? Good. All right. You're just muted there for a sec, but does that make sense? I think I got it all there.
Yep. What I can hear, my internet keeps dropping. It's done about 4 times during this recording, so I'm getting bits and pieces.
Okay.
Let's let's finish it up with the look ahead. What do you got coming up for this upcoming week?
Yeah, so I think there was a couple things I just wanted to comment on this week still as we wrap up. Like, this is the year of the meme. I think if we go back and look 10 years out from now, this is the year of the meme stock, because we saw some more of that this week. We saw Avis take off and go up a couple 100%. We saw Bed Bath and Beyond go up kind of 80% overnight when the short sellers stopped. We saw Peloton kind of get beat up today, and Digital World, which was Trump's digital agency. And so this has been kind of the year of the meme stocks. So you see huge volatility in stocks still. So I continue to watch that and pay attention to it. Next week, I'd be surprised if we don't see some selling in equities, because it's been kind of a continual grind higher. There's a few companies I'll continue to pay attention to, and a few ETFs, but I'd expect a reasonable amount of selling in kind of the high beta stocks that had a pretty good couple of weeks here. So I would look for that as a possible opportunity to go back. So next week I'd expect some softness in equities.
Okay.
Yeah.
Great.
Yeah.
All right. Last call for any questions. Just type them in there. Okay. Any final thoughts as we leave into this beautiful weekend?
Final thoughts, I guess, as I look at the week, when I compare it across kind of the different countries and indices, it's still tech leading the way. So, I'd continue to watch that. I continue to get lots of questions about the US dollar and the Canadian dollar. I think that over the kind of the medium term, next 3 to 6 months, I think there's lots of upside in the US dollar. So I'm not getting aggressive one way or the other. So I continue to watch that pretty closely. And so, yeah, that'll be something I keep paying attention to. And energy and commodities obviously play a big role in that. And so as a result of that, I think most of the energy expansion has happened. So I'm less concerned about the direction of Canadian dollar strength right now. So I'd say that's it. Yeah.
I should mention, actually, if there's ever a topic you want us to hit on, just like I mentioned Eric did, he always sends us emails ahead of time. So it gives us more content that you guys are looking for, so make it more relevant to specifically for you.
Yeah.
Free to email either me or myself, and we'll or both, actually, is probably best, and we'll fit them in there.
Yeah, we get and it can be about anything, not just the economy, but sometimes people ask me about individual stocks or things like that. We can certainly go into that as well.
Yeah, or sports.
You got it.
That too.
Yes.
All right, well, you're freezing again there, so I think I'm about just to drop my internet again for the 5th time today. So thanks everybody. Have a great weekend, and we'll see you next week.
Sounds good. Thanks. Take care.